Hey guys, I'm Tiffany Weeks, and today we are talking investment real estate. Yes, I know that this could clip on, but I like to hold something, so don't judge me. Me and Jessica are in the office, and we were talking through some of our listings, some of our clients, and making matches. And we started breaking down one of our listings. It's a income producing investment property, short-term rental slash vacation home near Walt Disney World. But it led us down this talk track of, are you evaluating the right things? Like, I get people that call all the time and they have all of these buzzwords, because you that go to YouTube University, and no, not because you're here, welcome. There's all of these buzzwords, right? Is it a BRRRR strategy? Is it the 1% rule, the 2% rule? Is it the 4-3-2-1% rule? Like, here's the thing. Are you evaluating what matters? So let me tell you a few things that you need to think through and talk through with someone who actually knows what they're doing so you can make the most of your investments, right? You need to evaluate your actual cash out, right? You need to talk through your initial investment. That's the cash you got to bring to the table to acquire this property. You need to think through your return on your investment, and then also the tax benefits, right? If you're evaluating those three things holistically, you can make good decisions. So let's talk through this particular property. Like I said, it's near Walt Disney World, Orlando. It's listed just over $300,000. So not a crazy expensive property, right? When you factor in today's rates, down payments for an investment property, closing costs, all those things, in order to acquire this property, it costs you around $85,000, right? So just so you have some real numbers to be able to make this make sense. So acquisition costs around $85,000. This property costs around $33,000 a year. That's taking into account your principal and interest, your property taxes, your HOA, and your insurance. Year to date, my clients have made $25,000 on the books already in July, okay? So they've made over 75% of what's needed to even break even, just over the halfway point in the year. And I will tell you, because I know this intimately, my clients have used the home as well because it's a vacation property for them too. So it hasn't been fully occupied. They've taken it off the market for periods of time. So if you look at initial investment, right, you're looking at around $85,000. We know what it costs to maintain the property is just over $33,000 a year. So if you made a minimal return, if you said, you know what, out of all the nights we had it up, one night, maybe 2 nights are profitable. If you just made $250 a month on this property in terms of profit, is that something that would be attractive to you? For a lot of people, they say no, not enough money. $3,000 a year doesn't make it make sense. But what if we turn $250 a month into almost $17,000 in benefits? Is it attractive to you then? So if you look at holistically evaluating this property, yeah, at a bare minimum, if you walk away and you make $3,000 a year, that doesn't seem attractive. But when you factor in the tax benefit, so if you have this property and you have a mortgage on it, you get to claim the interest. That's around $1,600 a month on this property, okay? If you're in the 24th percentile of tax brackets, right, like you're making just under $200K a year, that's a tax savings, like true tax savings of $4,500. So if you combine the $4,500 in taxes that you don't have to pay with the $3,000 in income, that $250 a month, you're looking at an 8% return on your investment, just looking at those two things, right? And for context, money market rates right now are like between 4 and 4.5%. So that's an 8% return, and that is not taking into account appreciation. In a regular market, appreciation, I'm not talking about COVID, I'm not talking about a recession or any of the extremes. A regular real estate market, you're looking at 3 to 5% interest year over year. We get that right now it's a tough real estate market. The stock market's all over the place. So if we looked at just 3%, if you factored in 3% appreciation, $3,000 at $250 a month in income that you would have made, and the tax savings of just claiming the interest, that gives you a 16% return on your money. That's food for thought. That is the way that you evaluate holistically an investment property, right? It's so easy and convenient to hear these buzzwords or to look at a piece of the puzzle, not looking at it holistically, and you may miss out on a fantastic opportunity. Or you may look at an opportunity and say, no, this doesn't make sense any way you slice it. It's important to work with someone who understands how to appropriately and holistically evaluate these properties. So if you're interested in some real estate advice, if you're interested in starting or growing your portfolio, let us know. Happy to help.